You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined today by my co-host, John McEwen. It's the 19th of June, 2022, and in this week's episode, we'll be discussing British American Tobacco, Boohoo, Tesco, Tate Lyle, Halfords, and Upwork. John, should we start with British American Tobacco?
So British American Tobacco, the UK's largest tobacco company, released a trading statement for the first half of 2022, which confirmed that the company was on track to deliver revenue growth of between 2 and 4% at constant currency, with mid-single figure adjusted diluted earnings per share growth at constant currency. However, applying current foreign exchange rates would mean a translation tailwind of 2% on an adjusted diluted EPS growth for the first half of 2022 and 5% for full year 2022. Full year operating cash conversion is expected to be in excess of 90% of adjusted profit from operations. The group also confirmed further growth in non-combustible product consumer base, and the British Americans' new categories managed to reach 19.4 million people in the first quarter. They expect this to continue to feed through into revenue and volume growth in the new category business. They're also expecting a marked improvement in new category losses, leveraging the company's scale and growing brand equity. They confirm that they will continue with a new category investment with over £1 billion invested during the first half to continue to build the strong global brands and capitalizing their momentum. The group's Views brand is now the value share leader in the US, being number one in 34 states with a 3.4% gain to 35.9% of the total US vapor market, and extending the overall global leadership position in vapor. In tobacco heated products, or heat not burn, the category volume share was up 1.5% in the top THP market to reach 19.6% year to date to April, with strong volume share gains in Europe with the Glow product. In Japan, the THP category volume share was 20.6%, down 60 basis points in the highly competitive market there. And the group plan a further rollout of THP into new markets in the second half. In terms of overall tobacco volumes, the group expected volume to be -3% rather than the -2.5% previously guided, partly as a result of the exit from Russia. Outlook for tobacco volumes in the US is expected to be uncertain, with rapidly rising gas prices and macro uncertainties compared with a strong year prior. Despite this, group cigarette value share is up 10 basis points April year to date, with continued good pricing partly offsetting by geographical mix and no accelerated downgrading in the year to date. Moreover, there's been continued value growth in the US, up 40 basis points April year to date, driven by premium brands Newport and Natural American Spirit. The group expects to deliver savings of at least £1.5 billion by the end of 2022. In the oral division, the group continued volume share leadership with 69.3% of the market, with Velo remaining the volume share leader in 15 oral European markets. However, the category share was down 3% to 31.7% in the top 5 markets. The group also draws attention to its continued progress towards their ESG ambitions and targets 18 carbon neutral manufacturing and commercial facilities to make their operations carbon neutral by 2030. The full year 2022 technical guidance, applying current exchange rates, they expect leverage to be within their full year 2 to 3 times adjusted net debt, adjusted EBITDA, underlying tax rate of around 25%, and gross capex of around 700 million, previously guided at 750, which is broadly in line with adjusted depreciation and amortization. The chief executive, Jack Bowles, came out and said, "In summary, we are proud of the progress we have made on our 3 strategic priorities, driving a step change in new categories, generating value from combustibles, and building a simpler, faster organization. driven by the strong growth of our new category business, which we're continuing to reduce the health impact of our business, while also delivering on our wider ESG targets. We are making strong progress towards our purpose to build a better tomorrow. In terms of valuation, British American Tobacco has a market cap of £77.7 billion and trades at around 10.5 times earnings, compared with a 10-year average of around 13. Currently yields in the region of 6.5%. Certainly, I think ethics aside, it looks like a very cheap business on paper. It's one that's in structural decline. I think because of that, it's going to have limited appeal to a lot of people, either for the ethics or just the fact that it is a business in decline, despite having electronic cigarettes and sort of less harmful products, not harm-free, but sorry, not harm-free, but less harmful products. But I think probably the reason it's in structural decline is something that will put off most investors. I guess in the current environment, because it's very defensive and cigarettes are going to be one of the last things people give up because of the addictive nature of them, maybe it will fare better than some of its highly valued competitors, and you're not going to see a drastic re-rating down, but I suppose nor are you going to see a drastic re-rating up. So it's probably not going to be particularly appealing to many people, although from a valuation point of view, it's certainly a cheap company. What do you think on it, Sam?
There are a few things. Firstly, I think it is a pretty decent trading statement. I mean, most of these trading statements from the tobacco companies are very similar. You do sort of know what to expect from them. I'm not entirely sure they should be going around saying that British American Tobacco is helping to build a better tomorrow. I think
you don't agree with that?
No, I think whichever idiot in the marketing department came up with that, it needs to be shot, because it's just stupid. Just accept what you are.
What about going carbon neutral though?
Yeah, it's still selling an addictive product. It is what it is. Like, I've got no issue with it. I've got no issue with the ethics of it. But let's not pretend they're making the world a better place. Like, they're just not.
Building a better tomorrow.
Well, I disagree with that.
Okay, fine. Let's move on from that.
Yeah. So I think the 5 billion in revenue from new categories by 2025 is interesting, because that would be almost 20% of the revenue, whereas currently it's below 10%. And the growth is very, very good. It's about 50% a year at the minute. The only thing really I took issue with is the £2 billion buyback. I would prefer to see a larger dividend, just because I think if you are an investor, I know we don't know how big new categories will end up, but I think you have to assume you're investing in a business that is in structural decline. And if there's something left at the end, that's just a bonus. But if it's in structural decline, you don't really want to be continuously buying shares. And I think when they're buying back stock, they're almost making that decision for you. I think it'd be better to just give shareholders the dividends. And if they want to reinvest the dividends, they can just do that themselves. Yeah. So that's the only issue I'd have with it. But I thought it was a good statement. And I think the new categories is very encouraging. Although the valuation is more expensive than when we've looked in the past, I think it was just very, very cheap then. And I think it's still very cheap now. So, yeah.
Yeah, and I suppose it's something that the revenue is probably not going to be dropping off a cliff like some of the other companies in the sort of current macroeconomic environment.
No, like you said, it's the last thing they'll give up. So a lot of customers.
And they did highlight so far they're not seeing people buying cheaper brands as much. So from their point of view, that's obviously good for the numbers.
Which is possibly why we've seen the share price increase a bit.
Yeah, I think it's probably also worth pointing out, in comparison with Imperial Brands, there's a lot more diversification geographically with British American than its other peer on the FTSE. So that's something probably that's factored into the valuation and why British American trades at a little bit higher price than Imperial Brands.
And also the new categories is a lot better than Imperial Brands.
Also true.
Should we move on to Boohoo?
Yes, go for it, Sam. So
Boohoo have come out with a trading statement, and they've said that in the 3 months to the end of May, revenue fell 8% to 445.7 million compared to last year. This was in line with expectations, reflecting the strong comparisons with last year when lockdowns boosted trading. Every region declined apart from the rest of the world, with the USA the worst performer. Net sales were positive, but declined overall as return rates continued to normalise. On a 3-year basis, total revenue was up 75%. Boohoo said it's made progress on its strategic targets, including tightly controlled inventory, which fell compared to the end of the year. The group still expects full-year revenue growth in the low single digits. Continued higher costs and competitive pressures mean underlying cash profit margins are still due to be 4 to 7%. The shares fell 12.8% following the announcement. However, I think they've actually bounced back a bit since then. Yeah, so they fell 12% and then they came back up the next day. So the business now trades at a forward PE of 19.7 because of the depressed earnings. And that is on very depressed earnings, by the way. I think it would be below 10 if it was on the previous year's earnings. And the 10-year average forward PE is 38. My view is this trading statement, I think, is quite encouraging. It's in line with what they'd already guided for, but ASOS came out about a week ago and said they were going to be worse than their guidance. So I think the fact that Boohoo hasn't had to do that probably supports our views that Boohoo is the better business of the two. I think if there's still going to be underlying cash profits, I'm quite happy with that. I know that the business is investing a lot it's making a lot of investments at the minute because it is expecting higher demand again after the current issues are sorted. And I do agree with management there. So I think the fact that they're still guiding for a small amount of revenue growth and those underlying cash profit margins of 4 to 7%, as a Boohoo shareholder, I'm quite pleased with this statement, especially when you do compare it to the ASOS one, which came out about a week before. And I actually topped up on it at about 60p a share, which I think is about half what I originally bought it at. What are your thoughts as another Boohoo shareholder on this statement, John?
I think it was probably better than expected, especially after reading the ASOS statement. I think overall I was pleased with it, and it was sort of what we expected, like you said. I think the other thing that's probably worth noting is if we do end up in a recession, that most of the Boohoo customers are 18 to 24. And they do live either at university with student loans or with their parents. So I think the spending and buying the Boohoo products is probably not going to be hit as hard as some more discretionary spending. So I think it's still in a fairly good state despite the volatility which is reflected in the share price at the moment. I haven't actually topped up, but I'm considering it.
So, I mean, there's not really much more to discuss, is there? Because it is quite a short statement. So should we move on to Tesco?
Yeah, moving on to Tesco's. So it's, a little bit less exciting, but it's Britain's largest retailer. They had their first quarter results out this week, with group sales, excluding fuel, growing 2% on a like-for-like basis to £13.6 billion and 9.9% on a like-for-like basis. In Central Europe, like-for-like growth was 9%. Sales came in at £967 million, and that's 11.3% ahead of pre-pandemic levels. The core UK and Ireland business saw sales grow 1.5% to £12.6 billion, which is 9.7% ahead of pre-pandemic levels. However, year on year, the UK and Ireland business saw sales fall in the low single digits, with inflated lockdown demand from the previous year. In both the UK and Ireland, the group continued to grow market share, with distribution of value product lines like Aldi's Price Match rising 19% in the UK. Booker, the wholesaler Tesco's purchased a few years ago, saw catering sales grow 57.4% with easier comparators. The Tesco's Bank saw a sales rise of 38.8% to £261 million, with the acquisition of the Tesco underwriting contributing and recoveries in the travel money and card sales. Ken Murphy, the chief executive, said, "We're seeing some early indications of changing consumer behaviour as a result of the inflationary environment, despite which guidance on profit and cash remains unchanged." I thought these results were very good given the tough comparators, and I think Tesco's is by far in the strongest position in the grocery market in the UK, particularly as Asda and Morrisons have been loaded up with debt since their recent private equity takeovers. And also Tesco's is much healthier than Sainsbury's, which is the one that's left publicly listed. Tesco's, I think, definitely have the pricing power as a result, and they're gaining market share with the proposition for quality and value, as can be seen with the Aldi price match and the club card prices. But they also got the finest ranges, which are doing well too. I think it's going to be tricky for Tesco with the inflationary pressures and also with many of their customers trading down within their own stores. However, out of the grocers, they're in the best position to deal with it. And if you look at the valuation of Tesco's as a business, it's trading at just 11.7 times earnings. It may be in line broadly with what their 10-year average has been. But I think when you look at the last 10 years, they have been a very difficult 10 years for Tesco's. And again, it's the best it's been in the last 10 years. And it's also got quite a juicy dividend of 4.5%. So I think it's a solid business to buy at the moment. I've got it, I'm holding it, and I'm happy with it. What are your thoughts, Sam?
Quite similar, actually. I thought this was very, very good set of results. I think the comparisons to pre-pandemic are very good. I also think that the valuation is very reasonable for the business you're getting. And I think the strategy of doing the price matching compared to Aldi, I think it's the right strategy, even if, I mean, the fact they've been able to do this and they're not changing the guidance, I think is excellent. But even if it was going to negatively affect the guidance, I think it's still the right strategy anyway, just from what we saw in the credit crunch, in terms of a lot of customers going to Aldi and Lidl and not coming back. I think it's worth just holding on to them. So yeah, I think they're very good results. And I think the strategy that they're adopting is the right one.
Yeah. And I think they had, like you say, I think they've learned from post 2008. And if you want juicier margins or you do put prices up, people will go to those German discounters. So they're not making that same mistake again, essentially.
As a shareholder, if they were to come out with a statement in a few months' time that actually, similar to the ASOS one where it said, well, actually, we're not going to meet the guidance, and it's because primarily of the Aldi price match strategy, would you still think it's the correct strategy?
I think I would back that still, I think, because I don't know what the better alternative would be. I mean, you'd be in for a rockier time over, well, however long the downturn does last for. But I still think it'd be the right strategy.
I think as well, it puts, because you mentioned before about, I think Sainsbury's would be okay. It's not a fantastic business, but it's okay. But like you say, with Morrisons and Asda being loaded up with debt, it could put quite a bit of pressure on them as well if Tesco isn't reacting.
Yeah.
And they maybe have to react.
Yeah, that's right. And I think it also means that there's less likely to be a supermarket price war, which there was in I suppose the mid 10s, which was really, well, it was really tough. It didn't do anybody any good. I mean, the consumer obviously benefited, but it didn't do any of the companies any good. But I don't think that's likely at all, because I don't think a lot of the competitors could afford it.
Yeah, I think they're in a good position, actually. Should we move on to Tate and Lyle, who are making their debut on the show?
Yeah, go for it, Sam. Introduce them.
Tate and Lyle are a company that I had never heard of prior to this, and they are a global provider of ingredients and solutions for the food, beverage, and industrial markets. The company operates through two segments: food and beverage solutions and sucralose. The food and beverage solutions segment operates in the categories of beverages, dairy, soups, sauces, and dressings, and bakery. The sucralose segment is a sweetener, which is used in various food categories and beverages and industrial starches. So they have come out with their full year results from continuing operations, and underlying revenue rose 18% to 1.4 billion, which reflects growth in both food and beverages and sucralose. And this fed into a 14% increase in underlying profit before tax to 145 million. Management expects pre-tax profit in line with market expectations for the new financial year, and plans to pass on rising input costs to customers. Capital expenditure is seen rising from 75 million this year to 90 to 100 million, in line with the strategy to invest in growth, including through acquisitions. The group announced a final dividend of 12.8p, bringing the total to 21.8p, and that's on a share price of 766p. This is a 29% decrease and reflects a lower overall earnings base following the Primient sale. So if we break those results down a bit more, revenue in food and beverage solutions rose 19% to 1.2 billion, reflecting an increase in both price and volumes, particularly in Asia, Middle East, Africa, and Latin America. Demand for items consumed at home, like packaged goods, remained strong, even as out-of-home products like industrial ingredients picked up following COVID restrictions. Operating profit rose 7% to 160 million, though inflation in the final quarter held growth back. Rising corn and other input costs meant operating losses in European primary products widened. Acquisitions helped new products revenue rise 35% to make up 14% of the division's overall revenue. Sweeteners performed especially well, with revenue nearly doubling. A recovery in out-of-home consumption helped volumes rise 15% in sucralose, driving revenue 13% higher to 163 million. Now, so sucralose is that's a much smaller proportion of revenue. So food and beverage revenue, 1.2 billion, sucralose, 163 million. The benefit of increased volumes on per unit costs offset rising input cost inflation and fed through to a 15% increase in operating profits to 61 million. And that compares to 160 million operating profits in food and beverage. So it does have much higher margins. During the year, the group sold its primary stake in Primient, a plant-based industrial ingredient maker, for 1.1 billion, and acquired Quantum High-Tech Biological, a Chinese daily fiber maker, and Nutriata, a chickpea-based flour and fiber maker. The group's productivity programs delivered 158 million, beyond the 150 million targeted and ahead of schedule. In the current year, the group expects the program to yield a further 10 million in savings. Underlying free cash flow fell from 153 million to 72 million, primarily reflecting the cost of the Primient sale. Net debt rose by 209 million to 626 million, as dividend payments and the impact of currency fluctuations on the value of debt more than offset cash flow. In terms of the valuation, it trades at a P/E ratio of 15.3, and that compares to a 10-year average of 12. And the prospective dividend yield for the next 12 months is 2.8%. So I didn't actually have a look at the debt before. So if that's 626 million, and underlying operating profit before tax is 145 million. I'd say that's payable, but it's getting towards the uncomfortable end of it. But I'd say the debt probably is fine, in my opinion, or at least be fine for me. I think these are good results, but firstly, this is the first time we've covered it, so I don't know a huge amount about the business, so I would need to get to know it a little bit better anyway. But I don't see how what it's selling aren't commodities. So yeah. I doubt it. I doubt it would ever be a business that I would find particularly attractive. John, what are your thoughts on the results in the business?
I suppose that would be my initial thinking as well. What did you say its market cap was?
I didn't. Okay. So I will get that for you.
Just to get an idea.
3.07 billion.
Okay. Yeah, it's not one that I'm sort of immediately drawn to, although the numbers seem to be very good. What are they like compared with pre-pandemic levels? Because is it sort of to do with the comparators being quite weak?
See, I think I'll struggle because they've sold a division, so I'd have to actually jump into it. I'll get a look at the financials, but I suspect because of the continuing operate, they've. Oh right. So 2020 to 2021, it fell off a cliff. But they had revenue of 2.8 billion and it dropped to 1.2 billion. And that's such a steep, and it's then in the last year that's just finished, it was 1.375 billion. So I think it's such a steep drop off. It must be the part of the business they've sold. In terms of the operating profit, that's dropped off a lot as well. So that was 296, then 116, now 67. Oh yeah. So here we go. Actually, so if we include the discontinuing operations, the profit, I've not got it for revenue, but the profit is basically in line with pre-pandemic. Okay. It's down very slightly if you include the discontinued operations.
Yeah. No, it's not one that I'm sort of particularly drawn to. Yeah, and I don't think it would be even make the watch list at all.
I'd agree.
Okay.
Moving swiftly on.
Oh, okay. This is probably another one that won't make the watch list. So Halfords, bike and car products retailer, had their full year results out this week. with full year revenue up 6% to £1.4 billion and 19.9% ahead of pre-pandemic levels. Like-for-like sales growth was 16.7%, mainly driven by the Auto Centre division, which has made a number of acquisitions. Overall, underlying profit before tax was down 9.7% year on year to £89.8 million, 57.8% ahead of pre-pandemic levels. And all of the following numbers are going to be compared with pre-pandemic numbers. So retail revenue grew 5.4% to £1 billion, and that's 15.2% ahead on a like-for-like basis. Motoring was up 6.5% with the sale of more day-to-day car products, and cycling sales were up 2.7% with the unwinding of demand and ongoing supply chain issues. Underlying operating profit was 43% ahead of the 2019 levels at £89.8 million, with improvements to gross margins. In the Auto Centre division, revenue nearly doubled to £368 million, up 23.4% on a like-for-like basis, with a benefit of 6 acquisitions over the period. Underlying operating profit rose 46.9% to £14.4 million, reflecting higher revenue, whilst margins declined with the new acquisition focused on tyre services, which are much less profitable. Halfords had a free cash outflow of £14.9 million, compared with a £133.2 million inflow last year, partly as a result of working capital changes and higher inventory costs. Net debt came in at £344.9 million, compared with £277.3 million last year. Profits are expected to fall by more than 20% next year. In terms of valuation, Halfords has a market cap of £343 million and has a forward PE of just 6, compared with a 10-year average of 11.8. Currently yielding about 5%, shares were down more than 20% on the results and are down 56% year to date. I think we've talked about the move into the auto centres and our concerns with that in previous podcasts, and particularly as most British people are buying cars on PCP deals, which often tend to package in servicing with a dealer. But I think also I'd be concerned about the cost of the labour in the sort of, I suppose, for the mechanics, which are likely to go up in what is already a competitive marketplace with inflationary pressures feeding in, and also the move to electric vehicles, which have much less scope for servicing. So it's sort of, I suppose, almost moving into an industry which is declining. And I think something else, even on the more traditional or combustion engine cars, that on the new ones at least, manufacturers are tending to lock their software down, have more specialist tools to limit servicing almost to authorized or franchised dealers, which I think again is a concern for Halfords and this expansion into the Auto Centres division. Quite apart from that, with the cost of living for consumers, I'd wonder whether people with older traditional combustion engine cars are going to start skipping services, albeit maybe a fossil economy, but just skipping services to save money, which could also impact on Halfords in the next couple of years. So yeah, in short, I didn't like it before, even when it was more sort of bikes and I suppose car maintenance products, but I certainly don't like it in the directions it's going and where it's expanding to. It did put up some good numbers during the pandemic when people were in lockdown. It managed to stay open and sell bikes, but going forward, I don't like it as a business. I think it's reflected in the price, but it's not one that I'd look at any further. Sam, what are your thoughts?
Yeah, I also had concerns about the auto centre side of the business, just because they talked about it as a big opportunity because the market leader in that business. There's not really a market leader. It's very, very fragmented. And I think we said at the time, you sort of look at that and think, well, that's probably for a reason.
Yeah.
I hadn't picked up the last couple of times that we'd done it, but I didn't realize as well that they were funding the acquisitions just through debt. So the net debt of 344 million with the reduced profits at 89 million. And then if you look at what they're expected to fall to in 65 to 75 million, with those reduced profits, I'm looking at that debt and thinking if I was a shareholder, it'd be getting to the point where it's quite uncomfortable. I don't think it was actually necessarily that uncomfortable before. It's just with the profits falling as a proportion of profits, I think it's at too high a level now. And then as well, if the dividend yield for the next 12 months is going up to over 5%, this isn't a Unilever or a British American Tobacco. If it's that high, that's probably because the market thinks there's a cut coming. So yeah, I actually think if I was a shareholder, I would want them to pause acquisitions for now and just see what happens in the next year or two, just because they don't need to be adding to the debt. And I'd also think about slashing the dividend too. I don't think it's a business that's in trouble at the minute, but I think we could be sat here in 6 or 12 months and they could be in trouble. I don't think the current strategy is the right one for the environment they're potentially going into.
Yeah. And I think the industry that they're going into also, it has all of those headwinds. So I don't think it'll be an easy few years for them.
Yeah. So shall we move on to our US company of the week?
Yes.
So it is Upwork, which we have covered before. We also covered Fiverr a few weeks ago. So if you're not familiar with Upwork, I would listen to the Fiverr one because we do talk about it a bit in that. But it's an outsourcing business, and you can just use it to hire freelancers for whatever work you need. So they have come out with their Q1 results. They actually came out a month ago, but I'm an Upwork shareholder and I can be quite lazy following them sometimes. So I hadn't got around to reading them yet. So I thought, well, I may as well just do it on the show because there's not really that many companies coming out with exciting companies in the US coming out with results this week. So I thought I'd use it as a chance to just catch up on Upwork. Firstly, I did want to say that the letter they do with the results, it's a lot of the US companies in particular that we cover, the quarterly earnings, they're not fantastic. They'll just give you this like web page and it's all right. The information's there, but they're just a lot of the time, it's like they're just giving you what they need to. Upwork have actually gone and done this 27-page document that's very easy to follow. It gives all the information you want, and it is absolutely, it's fantastic, actually. It's probably the best thing I've seen from like a company, especially for quarterly results. You expect it in annual reports and stuff like that, but it's very, very easy to follow, and they've given a lot more than they actually need to give as well. So I like that. So I'll just read out the bits that were interesting. So in the first quarter, gross service volume, which will henceforth be referred to as GSV, grew 27% year over year to over $1 billion, and all the figures will be in dollars. And revenue grew 24% year over year to 141.3 million. This is the first time quarterly GSV has hit $1 billion. They said on the marketing side, we continue to be laser focused on raising awareness of Upwork with customers and prospects, and we are encouraged by early signals from our brand marketing investments. This includes 20% and 24% increases in overall website traffic and client registrations, respectively, from levels in the third quarter of 2021 before brand marketing investments ramped up. On the sales front, we delivered another strong quarter with new enterprise clients deals up 33% year over year and enterprise revenue growing 57% year over year. Approximately 10% of our 2021 revenue stemmed from work where either the talent or the client was located in Ukraine, Russia, or Belarus. And approximately 10% of our own team members were located in those countries. I think from the end of May, they've frozen Russia and Belarus out now. So that actually, I think it's only going to be small because it's 10%. And even then that includes the Ukraine as well. But this is a business that rather than just complaining about it when it's 1% of revenue, they will feel a bit of a pinch from what's going on in the Ukraine. Active clients increased 16% year over year. And they ended the first quarter with approximately 793,000 active clients. GSV per active client increased 18% year over year to 4,742. So the people on there are spending 18% more than they were a year ago. and their take rate was 14.1% overall, up slightly from the previous quarter and down from 14.4% in the first quarter of 2021. Worth noting that take rate is significantly lower than Fiverr's. I think Fiverr's is about 25% in total. So total revenue grew 24% year over year to 141.3 million. Marketplace revenue for the first quarter was 129.4 million, reflecting a year-over-year increase of 24%. GAAP gross profit was 103.4 million, or 73% of revenue, which was flat compared to the prior period as a percentage of revenue. The operating expenses for the first quarter were 127.1 million, which represented 90% of revenue, compared with 80% in the prior year, with R&D increasing from 23% of revenue to 27%, and sales and marketing increasing from 35% to 41%. And there was a GAAP net loss of $24.7 million in the first quarter, compared with a loss of $7.8 million. However, this is a business with $673 million of cash on the balance sheet. So it is one of them companies that's profitable by choice. But if they're going to lose 24 million a quarter, it's going to take about 7 years for them to get through the cash they've got on the balance sheet. So they can absolutely afford to be doing what they're doing. They're in a very comfortable position. They're also guiding for revenue of 590 to 610 million for the full 2022 year. In terms of market cap, they are trading at $2.44 billion, and that's down quite a bit. So it's trading at $18.70 a share, and that compares to a 52-week high of $64. So this is a stock that's pulled back quite a bit, and it now trades at a price to sales ratio. If you use the 2022, the mid-range of the midpoint of the guidance for 2022, that puts it at a price to sales of just over 4. I think these are very good results, and I think these are very good results on very tough comparatives. I think it was about 40% growth last year from memory. And I think 4 times sales for a business like this that's growing fairly consistently at 20% plus a year now, at such a low market cap in a market which I think could be very, very big. And it's a business that I think is now being led very, very well under Hayden Brown. And as well, they are in a position where they are very comfortable in terms of cash. So yeah, I actually think this is quite cheap now, especially given its price where it was pre-pandemic, and the business is probably 60 or 70% bigger now.
I was going to ask you, Sam, what do you think the biggest threats to Fiverr and Upwork are?
I think Microsoft. I think it's a sort of thing where I could see potentially, like, could Microsoft be doing a bit more with LinkedIn that would make them worry, or could Microsoft launch a competitor, or would Microsoft just buy one of them, and that would be a big problem for the one that wasn't bought. In terms of the take rates as well, Upwork's is a bit lower, about I think they said 14% on average. Fiverr's is considerably higher, it's about 25%. So it'd be more of an issue for Fiverr than for Upwork, I think, in this case. But if those take rates go too high, it's much easier. People are much more likely to just, basically message the person and be like, look, here's my email, let's do it off platform, and just cut them out entirely. I think there's a risk of that as well. I guess the only other threat would be, regulations. If you sort of got, like you've had with Uber, where you're getting a lot of people being like, well, are they employees? Do they have to provide like certain, do they have certain, do they have these responsibilities? So I think with Upwork, it's much more clear that it's freelancing, in that you're actually working for companies and stuff. Whereas with Uber, you're always working for Uber as the driver.
Sure.
So I think it's probably less of an issue for Upwork, and for Fiverr, but that's maybe potentially something that could cause an issue, at least in some cities or some areas.
Yeah, it has such a big coverage though across the globe that's maybe less of a concern.
Yeah,
it's not heavily focused in sort of one market.
Yes, if you get like, like I think they're quite into that sort of stuff in California. So if you get it in California and they end up locked out of there, it wouldn't be a disaster. But I think it's much less of an issue for Upwork and Fiverr than it is for Uber, just because of the nature of the work that you're doing and the fact you are engaged by the businesses directly. I think if anything, if you're doing all your work for one client on Upwork, I think, the argument would be much more that you're actually employed by that client than you are by Upwork. I don't even know if it would be Upwork's problem.
And at that point, it might be cheaper for both parties. to just work together without the middleman in there.
Yeah, so well, I think because Upwork guarantees, because it's got escrow and stuff, so you can escalate if there's problems and stuff. But yeah, like you say, once you've built up a working relationship with someone, the fees do drop after a while once you get over certain thresholds. But even if the fees drop to 10%, if you're doing like a lot of work for someone and you've worked with them for like 6 to 12 months at that point, you probably trust them enough that you'd rather just not pay the 10% fee. You don't really need the security. And if you're actually doing work for a proper business and invoicing them, if it's not like if they don't pay you, you've got like other actions you can take as you would with any other business that didn't pay you. So that would be an issue if it was. But then equally, some of those people, like it might not work out, or it might be a couple of years and then they come back to Upwork. So so what are your thoughts then on the results in the business?
I mean, I think the results are very good. Obviously, it's the growth that it's delivering, while it's not yet profitable, but the growth that it's delivering is really impressive, and it's not at the outrageous prices that it was a year ago. But I think it's a growth industry, and it's one that I am quite attracted to. I just haven't been brave enough to dip my toe in. And we're getting to the point where maybe taking a basket approach, buying Fiverr and Upwork, I would consider. I'm not quite there yet, but they're definitely going onto my watch list properly now.
Oh, very nice. Of the 6 businesses we've talked about today, then British American Tobacco, Boohoo, Tesco, Tate Lyle, Halfords and Upwork. If you had to buy one, which one would it be?
I think I would probably go for Boohoo at the moment, closely followed by Upwork. And it may be that I act on that this week and go ahead and top up on my Boohoo shares, I think. What about you?
So I'll exclude Boohoo for myself on the basis that I have just topped up on it this week. So it's a bit unfair. For me personally, it would probably be Upwork out of the 5 that are left. But if you were someone where you wanted to sleep well at night, I'd probably be going with Tesco, because I think that's very attractive.
You wouldn't sleep well with Upwork. Or
I would sleep well with Upwork, but some
people
people might not. Although I think you sleep a lot better now at the current valuation.
Yeah.
But it is just, it is still just a riskier business, because the profits that we're expecting in the future, they might never arrive. Whereas Tesco's profitable now, and it's very reasonably valued for the profit it is delivering consistently.
Yeah, absolutely. Okay, well, thank you again for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.